You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network, and I'm Kerry Lutz. Well, inflation is with us. It's big. Oh, I should mention the date, 2/10/22. And getting back to inflation, it's here to stay. Inflation is a cycle. We had it in the 60s and 70s. It lasted upwards of 20 years. You could argue on that. You might say it's only 14, or you might say it's 18. Let's say 20 years. Point is, we're at the beginning of an inflationary cycle right now. And the question is, what are you going to do about it? If you have any retirement plans during the next 20 years, if you're going to be retired during this time, if you are retired now, what do you do? That's really the trillion-dollar question. And here with us from 55retire.com is our good friend, Mark Singer. Mark, how do you inflation-proof your retirement?
Kerry, how are you? You know, I'll start with a story. I remember when I got out of school, I bought my first condo here in Back Bay in Boston. And at the time, I think I bought it for $39,500. And the mortgage on it, the mortgage rate was 17%. I remember a couple years later refinancing happily at 13%. Times are just a little bit different. You know what I mean? It's interesting. You know, we specialize in the transition into retirement. And one of the biggest questions we have is, you know, how do I generate the income that I need? And we're in a very interesting time. When we mentioned that 17% mortgage rate and the 13% mortgage rate, it was about just a few years after that. I remember seeing one of my first clients in this business. I've been doing this now for 33 years. Came in with a treasury note that was paying 14%.
Wow.
So it's not, people get confused about inflation and its impact on fixed income. If inflation is high and the interest rates you're getting are high, then you're not really losing very much from a fixed income perspective. But that's where it's broken right now. Right now, we're looking at, I don't know what inflation numbers you want to believe, but call it 5, 6, 7%, whatever the number is, somewhere upwards of there. Yet interest rates continue to be somewhere between 0 and maybe 1.5%. So those who are relying upon inflation proofing their income, which means we know we need more income each year because prices are going up. The problem is we're not getting that increase in income anymore. And that is a real problem.
That's a big problem. Well, unless, I've heard recently this past Halloween that there was a ghost at the Federal Reserve, that it's haunted. And this ghost was about 7 feet tall. He carried a cigar that was about 3 feet long, and he didn't want to mess with this guy. I'm talking about Paul Volcker. So unless the ghost of Paul Volcker infects the Federal Reserve policy in a major way, we're going to see financial repression in the form of gravely lowered below market interest rates, highly negative real interest rates. That's going to be the trend. It's going to be a disaster. It's going to have so many unintended consequences, you're not even going to believe it. But that's where we're heading. In that environment, yes, I remember I had some Ford Motor Company bonds that were paying 21% because nobody knew if Ford Motor was going to exist or not. I think I sold them when they started only yielding 10%. My first mortgage was on a co-op in Fort Lee, New Jersey, that I paid $117,000 for. This was in '83. I was paying 8.5% adjustable rate on that mortgage. Over the past 40 years, Mark, if you had maintained an adjustable rate mortgage, and if you could get the LIBOR before they started rigging it, or before they let it go free flow, let it go free. If you had a LIBOR mortgage, you made out like a bandit because your real rate was close to zero.
Right. And, one of the headlines that you don't see, okay, we've heard about the extraordinary bull markets on the equity side of things, right? And we've gone through different cycles. But the headline that most investors don't see and don't realize is that we just went through, in essence, a 40-year bond bull market. And it's not a sexy headline because the numbers aren't really big, but they're good and they're solid. And as interest rates have come down over the past 40 years, the value of your bonds have gone up. Well, what we're looking at now is we've bottomed out, I believe. Can't go much lower other than going negative, and I don't think that will happen. But now interest rates are going to start going up, which means the value of your bonds are going down. Now, what does this mean to the investor? Well, last year, the U.S. core aggregate bond index was negative 1 point something. And the expectations are for this year, for the first time in many, many years, the expectation is we are going to have back-to-back negative total return for the U.S. core aggregate bond index. And it's the bonds, it's the fixed income that so many of the retirees have been depending upon in addition to their Social Security or their pension if they were getting one. So now that we're getting, let's call it maybe 1%, and we've got inflation going up at 6, 7, or 8%, or it could be 20%, depending upon the sector you're looking at, or even if you can get the supplies you're looking for in the grocery store, it becomes a real problem. So you really have to think now about changing the manner in which you invest. And having invested in bonds and fixed income for as long as many people have, they have felt very safe and very comfortable with that because, again, the interest rates are coming down. I'll tell you a story. So I've got a 90-year-old who retired 36 years ago. His entire portfolio after he sold his business was put into municipal bonds every single year. He's been collecting Social Security. He's been collecting his tax-free municipal bond income, and he has been great until the last few years. And for the first time in his life, a year ago, he had his broker invest in a bucket of dividend-yielding stocks. I just spoke to him just a week ago. 6 months ago, he was feeling very good about it because the market was going up for stocks. Right now, he's not feeling so comfortable with it because of the volatility, and the income is still less than what he was getting on the fixed income. So it really becomes a problem for those who wish to maintain safety or comfort level or peace of mind, sleep at night levels, yet their income's going down. So you really have to understand what's in the fixed income. You may have to get a little bit more active managers who are navigating in the fixed income area. Just like equities, where there's many, many different styles and different ways to invest in equities, large cap, small cap, domestic, international, growth, value. There are similar different boxes in the fixed income that you can also navigate. And to understand that in talking with your advisor or talking with the firm you work with, you need to understand the difference between the short-term duration and the long-term duration, and then the difference between low-risk fixed income versus high risk, like high-yield fixed income. And you just may be needing to change that bucket around a little bit more than you had in the past.
Yeah, so talking about dividend stocks. So presumably somebody's a long-term fixed investor. They're not really watching the underlying value of the bond because they're going to, in theory, hold it to maturity. Maybe you shorten your duration in inflationary times. But right now, the SDY projected dividend yield for this year is 2.68%. So that's an ETF. Now, granted, you can find higher yielding stocks, but you don't want to be what's called in the industry, or what's adoringly called a yield whore, because just chasing yield with no consideration of the underlying risk is a fool's errand that will cost you dearly in the long run, because the highest yielding stocks are the stocks that are in the worst condition, that have the highest likelihood of cutting the dividend, thereby cutting your return on the stock. So just yield for yield's sake, bad move. But there are companies out there yielding in the 3 to 5% range. I happen to like, and I'm not recommending anything. Unlike you, I'm not licensed, so take my advice with a grain of salt. It's not advice. Midstream pipeline companies I love, because it's a great play on rising energy prices. Do you look at MLPs? Do you look at REITs, Mark? What do you look at?
Don't just survive, thrive. The Financial Survival Network.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700-ton per day mill with an 8 million-ton tailings facility ready to be used. There is already power to site, and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year, or over 60 million pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
So I'm glad you brought that up in terms of the yield chasing, by the way, because I've had a couple of my clients who called me about a particular ETF that is out there that is yielding somewhere in the vicinity of 10 to 12%. And we took a deep dive into that particular investment and how they were getting this return back for their investors. And in essence, it was just returning the money that the investors had put in. It wasn't what you would think about was a real dividend or yield. Nothing was covered. And if you don't really understand this, then you may get caught. And I think the best thing to remember is, if it looks like a duck and walks like a duck, it probably is. And if it's anywhere north of that 3 to 5% that you just indicated, Kerry, I think somebody really needs to do a deep dive to figure out if it's something they want to be in, because most people who are looking for yield or income are not looking for a lot of risk. They're not looking for per se growth or want to get out there on the yield curve. So be very, very careful. If it, you were talking about the dividend yielding funds or ETFs. In my head, I was thinking, 2 to 3%. I mean, I think that's a pretty good number right now as to where we are, which is much better than where you can get most of the fixed income yields. But remember, you do have the underlying risk of the individual stocks. But if you're a long-term investor and you're in high quality stocks, if you will, and with those companies that have historically increased their dividends, which is a real key to picking those types of stocks, then you're going to be okay. But if you're looking anywhere north of that 5% number, be wary.
All right. Here's a great one when you mentioned it. So I'm big on dividends, but predictable dividends, because it harkens back to a day when stock valuation took place using the dividend discount model, which meant that the price your stock was trading at was the sum of all projected future cash flow discounted to current value. There's formulas for that. Don't ask me what they were. That wasn't my major in college. But point is that there's one here right now. You could just do list of top 25 high dividend ETFs. And this one here has an annual yield of 21.94%. 21. Now, I love good things, but sometimes things are just too good to be true. I'm looking the chart. This thing's only been around since 2020. Right now it's trading at 2165, 2155. At one point in March of 2020, this thing was trading at 1393. December of 2020, 1663. And at its peak, which was also in December, it was 2146. So it's now trading at or near its all-time high, Mark.
Yep.
I mean,
hey, that's when I want to get into it. Isn't that when you want to get into it?
No, hey, maybe it was a great time to buy it in March of 2020, where you probably could have gotten a 40% yield. But, the best time to buy these dividend aristocrats at the highest yield is right after a market correction or crash, because nothing has changed in the fundamentals. For instance, like Procter Gamble. Okay, that's one of those dividend aristocrats. They've been paying dividends since before the Great Depression, increasing every quarter. But, after the crash, it might have been yielding 3% as opposed to, almost 2%. So that is a good thing. But as a retiree or an approaching retiree, can you afford to time the market?
Absolutely not. And you can't. And most of the funds or investment vehicles that were looking to time markets outside of hedge funds are now obsolete. They're no longer available because you just can't do it. You can't do it going out and you can't do it coming back in. You have to make the right decision twice perfectly. So I think that, one of the things is, you talk about corrections. A lot of people just don't have cash sitting around to take advantage of the opportunities that corrections present. And I think that's part of, one of the things that's my mantra. I think our industry's done a lousy job of educating people as they approach retirement. I think the first thing you have to do, and it gets back to the planning, Kerry, what is your retirement number and what income do you need to chase investment names, to chase yield, to all of a sudden, as you retire, decide that you have to completely reallocate everything that you've invested in, then you haven't done the planning right. And it's all about, 2, 3, 5 years beforehand, because most people don't, plan much further from their retirement than that. Sit down, either do it on a calculator online or work with an advisor to find out what your needs actually are and how much risk you need to take with the portfolio, and then find out, what investments you should have. I say to folks who are retiring, who may be rolling over a 401k or a 403b, they may want to do some dollar cost averaging. In other words, investing over time on a systematic basis in order to try to, eliminate the ups and downs of, and not worry whether or not they're putting the money in at the right or the wrong time. Dollar cost averaging can help you minimize the risk of putting money into markets. And when I say markets, that's also fixed income and bond markets as well, because they're just as, if not more volatile than the stock markets. I think people just don't understand that.
Mm-hmm. And so these yields, like I should specify that these were high yielding ETFs. They aren't necessarily getting them on dividends, but it's quite amusing because people are buying them as if they were yielding return, as if, this is this crazy thing.
If you are uninitiated, you can get really caught in a trap here. You could step on a landmine that could really cost you your retirement. You just got to be very, very careful. And if you're up at night worrying about this, I'm in the business, this is what I do. This is how I get paid. This is how I feed my family. But it's also the value that we give as an industry to our mass of clients can be invaluable to many. And it's not just about the numbers themselves, but it's also a sense of peace of mind or sleep at night that we call it, that you know that you're in the right hands and doing the right things, particularly in times like this. One of the issues that we're facing this year, which will make, there are numbers of issues that this year will force a lot more volatility in the markets than we have seen in quite some time. One of the big ones is going to be the midterm elections that are upcoming. And, history shows us that markets are much more volatile moving into these markets, regardless of whether you're red or blue or split in Washington. But afterwards, the markets seem to rebound. But behavioral finance seems to indicate that most people, when the markets go down, they leave the markets. They don't stay. They don't have that commitment, that due diligence, that dedication. So, as a sort of a look into the future, as the wizard here, if you will, make sure that over the next 6 or 9 months, as we do look upon, midterm elections, that whatever the portfolio is you're comfortable with now, stick with it, because you're going to see volatility, but markets go up and markets go down, again, both on the fixed income side and the equity side.
All right. Well, I think we beat this horse dead. If you haven't figured out by now, you got to have a strategy, whether you're approaching retirement, in retirement already. You really need to be thinking about how inflation is going to affect the amount of money you have to spend in retirement. And Mark's an expert in this, 33 years he's been doing it. Mark, where do we find you? How do we connect with you on the web?
Sure. So, if you are going to transition, we have a quiz that you can take. It is www.retirenowquiz.com. If you fill out the quiz, invest 2 minutes in yourself, we'll score it for you to tell you which of the 3 retirement preparedness strategies you're in. I'll get you a free chapter of my new book, Don't Outlive Your Money in Retirement, and some worksheets so you have a little bit more clarity in terms of where you're going. You can also find us on the web at 55retire.com.
All right. And there's a link to it on in the show notes on financialsurvivalnetwork.com. Make sure you go there and sign up for your free newsletter. And if you got a question for Mark, just shoot us an email, kl@kerrylutz.com. We'll get you an answer. Mark, always a pleasure. Thanks so much for coming by.
Kerry, thanks.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.